Hi, and welcome to Wescott's latest Economic and Market Outlook series. I'm Mark McCarron, Wescott's Chief Investment Officer. And today, October 23rd, we're going to take a look at the economy, the market, and the title of this is Looking Beyond the U.S. Election. We're within 2 weeks of Election Day, and we talked a little bit about that the last time, but we're going to look beyond just November, but the policies that may impact markets going forward. So as usual, we're going to talk through the market update. Got some updated numbers through yesterday. The main focus today is, as I mentioned before, looking at the policies in place by both Republicans and the proposed Democratic plan to determine what impact, if any, it will have on the markets going forward. And then finally, where do we stand in terms of our current outlook? So first, the market update. Generally, we're getting new data every day, and the economy continues to improve. One thing we look at very carefully is the labor market, the unemployment situation. It does continue to recover, although it is at a slower pace than earlier this summer. The positive out this week is that the U.S. housing market is continuing its strong performance. Demand is high, supply is low. House prices are stable and rising in many parts of the country. This is despite the fact that we're living through the pandemic. So that's a positive for the economy. It's a positive for wealth creation. And it's important to look at how that impacts consumer spending going forward. It's also happening even though negotiations over additional fiscal stimulus, which includes payments directly to households and to businesses, those negotiations continue, but does not look like it's likely to be passed until after November 3rd, after the election. And given the fact that the US presidential election is less than 2 weeks away, we're interested in looking at how voting is going. Early voting, by the way, has been higher this year than in previous election years. And market volatility, remains stable as we come close to election day, although it's stable at an elevated level, as we talked about last time. And I think that's because the uncertainties are still there. What policies will be in place? What will be consistent? What will change? And how will that impact portfolio allocations? So what are we seeing? Really important, I think, is to look. This is albeit a short-term focus, but this year has been a year dominated by technology and dominated by growth companies. But there seems to be a shift going on, at least through October 22nd. So it's the fourth quarter so far. On the right-hand side, we're showing performance of our fairly standard indexes that we talked about in the past. The S&P 500, the broad market, is up 2.8%. But if you equal weight those 500 companies, it's up actually 5%. And so what that means is that it's not as dominant or not as concentrated a performance as it has been this year so far. And to the right, we're showing performance of growth companies, which were, again, the key driver of market returns this year, still remain in very positive territory year to date. But quarter to date, meaning so far in the fourth quarter, it's small companies, value stocks that are leading the charge. And why is that? So there was a brief sell-off in September, led again by the technology that have been dominant so much this year. But the market hasn't fallen, it's actually gone up and continues to go up. But the performance differential between growth companies and value companies, which is something we look at very carefully, is starting to close somewhat. And it is a sign that the economic recovery is continuing as expected. We talked about this before, but our research firm that we look at very carefully, bank credit analyst, highlights this, and they sort of termed it the pandemic trade, which is stocks doing very well during this environment, maybe shifting to a recovery trade, those that are dependent on a return to normal. And we're seeing some evidence of that, and we look carefully at how growth companies versus value companies are doing, or in other cases, how stocks are doing outside those top 10 S&P constituents. So with that, that's where we are today, and the market is up, as we talked about, and we're only 2 weeks away from the election. So in our view, I think the market is looking beyond the election, and we are on the home stretch. National polls and betting markets, as we talked about 2 weeks ago, still show that Democrats are favored to win the US presidential election in November. Although the gap is narrowing a little bit from where we were 2 weeks ago, and it may not be fully reflective of the final debate that was held last night. I think, why is the market up and not concerned about potential change? I think the market expects large government spending plans from both candidates. Although the focus of each spending plan on certain programs and the tax policy between Democrat and Republican are clearly different. So why don't we take a look at that? And I think, the current focus of the market is how much government spending will there be? And in both cases, there's going to be a lot. Debt, though, as a percentage of GDP, has been rising for many years. If we go back to January 2000, debt to GDP was around 60% in the US. And it reached over 100% back in 2015, has been slowly rising, and now is well over 100%. And government spending, whether it be on childcare, education, healthcare, long-term care, Social Security, all of these programs, defense, infrastructure, they're all expected to go up in one way, shape, or form, regardless of who wins the election in November. But the impact on the deficit over the long term will be similar, whether there's those additional spending would be covered by additional taxes, as the Democratic plan calls for, or smaller increases in spending, but no tax increases, at least currently, from the Republican side. The market is not really concerned about how high the federal debt is getting relative to GDP. And that's well beyond the US election this year, but an issue much further down the road. And we talked a little bit about that in our most recent commentary. So I think the reason why the markets are stable and rising is because they are expecting, at least in 2020, 2021, more government support for the economy. So what does that mean? As we talked about before, the current outlook, we think we are in a potential regime shift, this idea of from a pandemic trade, where there was a flight to quality under the uncertainty of the pandemic, to a recovery trade, which is looking beyond the short-term risks and looking at a return to normal. Economic conditions are key. We continue to see them improve, despite the fact that virus case counts are increasing. Unemployment is high. The uncertainty surrounding more government stimulus, as we talked about, is still out there, and the upcoming election in 2 weeks. The equity market strength this year remains concentrated in growth stocks. In fact, not just this year, but the last many years. Yet valuations are getting stretched. They're getting expensive. And as we talked about, the fourth quarter trend that we're seeing so far suggests that the market leadership could be changing to those stocks that are more economically sensitive. And the final bullet point here is just that we do continue to see a U-shaped economic recovery. And we do think that recovery will broaden out. The market should broaden out with some of those economically sensitive sectors, whether it be airlines, hotels, restaurants, businesses doing better going forward. So with that, we again thank you for joining us. We thank you for your confidence and trust. And as always, if there are any questions, don't hesitate to reach out to me or your advisor. Thank you.